we're here with Mickey Fulp. Unfortunately, we couldn't get together at the PDAC 2015. You got held up, Mickey, at the airport?
2 days in a row, freezing rain in Dallas the first day, shut down the airport. A big snowstorm in Albuquerque that night shut down the airport for the next day, so I just bagged.
But thanks for joining us here at the office here. Again, Mickey Fulp with Mercenary Geologist. And you've done some really interesting papers of late. One was really focusing on the real cost of mining gold. And that really caught my attention, given that the gold price right now, today it reached $1,200. But,
right.
Let's lay the groundwork. First of all, you work in conjunction with Cypher Research in Vancouver. You've come up with some pretty interesting conclusions and analyses. One of the things that they mentioned was since 2003, the gold price has gone from $344 to $1,260 approximately. And that's a 266% gain. But most of the gold, most of the major gold miners are still not profitable over this period. And in this last quarter, you've seen, again, even in the silver space, additional write-downs. So, what are the two non-GAAP measures that you looked at?
So from 1990 till 2013, the gold mining companies adopted this thing they called cash costs that was supposedly going to allow you to compare and contrast the potential profitability of any mining company.
Right.
Well, those are basically operating costs, and they don't account for the real cost of mining gold, not even beginning. So we would see companies $500 or $600 an ounce, and gold prices $1,300 or $1,400, and they're still losing money. Well, how do they do that? So because that was not a good metric in 2013, the World Gold Council, which is composed of 21 large and mid-tier gold producers, came up with a new thing called all-in sustaining costs. But that doesn't tell us the whole story either. Lots of stuff missing out of that. And so we went through that and showed that not only are these non-standard, non-GAAP measures, but you can't compare company to company, even in all-in sustaining costs. Some include some stuff and don't include others. And not only that, it's even confused the issue because companies from year to year don't report same standards. There's byproduct, gold, co-product, all this other stuff. So it doesn't really work.
So what were some of the things that you found from the producers? What were some of the conclusions then, just in addition to your comments now, based on these non-GAAP measures?
And what they do is they take operating expenses and a certain percentage of those or certain criteria, they'll move into capital expenditures and depreciate that. And so those costs don't show up in the all-in sustaining costs, and they really don't show up on the balance sheet except as depreciation expense until the asset goes bad and they're written down.
Interesting.
So essentially what they're doing is they're making themselves appear short-term profitable, but it comes back to bite them in the long term.
And why, and what are the conditions for a producer to be in a position of producing healthy cash flows? What are some of the...
Well, they basically, the revenues, which is operating cash flow, operating from selling gold, if you will, has to exceed the operating expenses, what we call IMP, investment in mining property, that's the aforementioned capital expenditures, plus debt repayment, plus dividends. So you take revenues divided by those four things, it's essentially cash inflow versus cash outflow, and we call that the adequacy ratio, or I should say Cypher Research calls that the adequacy ratio. And if a company's adequacy ratio is greater than 1, it's healthy, and if it's less than 1, it's unhealthy. And what we showed was over this 11-year period with 7 major gold miners, none of the companies were profitable on the long haul. The industry as a whole was only profitable in 1 year, and that was barely profitable with an adequacy ratio of 1.01.
Wow.
In the 11-year period we studied, and that 1 year was 2011 when the gold price hit its all-time high.
What is the real root of the problem, and what are some are there some potential solutions out there? we can do.
Cypher and I think the real root of the problem is that companies have focused on growth. They want to grow their production levels. They want to grow their resources and reserves. What I call a Wall Street style of capitalism, growth for growth's sake. And so by doing that, then they are able to appease the shareholders and the analysts on a quarterly basis. But there's no looking into the longer term. So like good scientists and engineers that we consider ourselves to be, we propose a solution. The solution's easy. They need to become value companies. Mining is not a growth industry. Historically, it's a value industry.
Right.
And it's all about margin. So you want to be in a low lowest quartile of producers. In other words, your all-in costs are protected against the rise and fall in prices. No matter what the gold price is, you will continue to be profitable, and you want to maintain that margin. So under that scenario, gold production would go up when gold price is high. It would automatically go down when gold price is lower, because you want that margin. Look at it as a ribbon, and that ribbon is always constant no matter what the gold price is. You're still maintaining a high margin cost per ounce.
Right.
And if the mining companies choose to be value companies instead of growth companies, eventually the market's going to come around and say, this is a value company.
Yeah.
I mean, look at the Dow Jones Industrial. There's 30 companies, and a significant number of those companies are value companies,
right,
not growth companies. So we think that's the solution for the gold mining industry.
So, you mentioned, that's very interesting points there in regards to the, quality quantity over quality. How long has that been happening for the last few years? And where does that leave the remaining number of ounces to be produced at a high gold price? Or is there enough ounces to be produced from?
Well, certainly,
discoveries.
Yeah. The problem with discoveries is the junior world's in a,
Yeah.
juniors are in a world of hurt too right now, and that historically is where the majors get their deposits. They're not very
Right.
good at exploring. The bureaucracy gets in the way, so you leave it to the venture capitals and entrepreneurs to make the discoveries. Those are not going to happen for a while. So the idea that we're going to peak in gold production, or in 2014, we've seen this rise in gold production year after year after year, and 2014 was the highest ever. We would expect that's going to start to come down now in 2015 because the pipeline's been cut off. But what we found during the quote good days in the business is that the majors go out and they pay too much for their acquisitions. It's kind of ridiculous,
Right.
some of their acquisitions, and then they write them off. Probably what's most damning about it, it appears that they go into debt to pay dividends.
Right. Okay. So you heard it from Mickey. So I guess you really want the sector to just come back to value. That's what matters the most.
Absolutely.
Quality ounces. Look for those discoveries, and let's get back to what the sector was: value-based investing in these projects.
And I dare say that it's not restricted to the gold mining industry.
Absolutely.
Cypher has only done research on the gold companies. But I feel certain it's rampant throughout the mining industry and probably the oil and gas business too.
Yeah.
And it really has to do with the fact that under accounting rules, a lot of stuff that should be classified as operating expenditures, or the cost of producing a unit of metal per ton of rock is a lot higher than they show on the books.
So thanks, Mickey, for being on the segment today. Really important topic, real cost of mining gold. If you want to check out more of his papers on this topic and various other topics on the sector, visit Mickey Fulp at mercenarygeologist.com, and also get a chance to get in touch with his partners at Cypher Research in Vancouver. We'll provide their information as well. Mickey, thank you.
All right, thanks a lot, Sonny. My pleasure.
Cheers.